Hey, everybody, welcome to the podcast. Today is Hump Day, February 19th. The stock market is closed, and you're not seeing things. It's actually a down day today. I know it's hard to believe. It's kind of the complete opposite of the days we were going through and late January, early February, where every day seemed to be down. And now that we have reached this old high, natural selling came in today. The Dow Jones finished down about 88 points, about 0.5%. And as we go up the risk scale, we saw the losses deepen. The S&P was down about 12 points, down 0.63%. The Russell 2000 was the worst. It was down over 1%, down 12 points. Interest rates were up on the day after the Fed minutes came out, and we'll get to those in just a minute. So, and we also had some, stuff going on in the Ukraine. Some social unrest, so that doesn't ever help anything. But we've obviously seen this big move down. We broke all kinds of support, kind of went in between the 100 and 200-day moving average. And since that time, we got the bounce. And during this time, we spent a lot of time really going back and looking at corrections versus bear markets, and we kind of felt like this was going to be a correction. I would still say, though, regardless of what happens going forward over the next few days, that we're still due for a correction, a more exaggerated correction, one that lasts for a little bit longer, it's a little bit bigger, and we haven't really seen that yet. When you get 6 or 7 days down like we did and it dropped about 6.5% and it reverses so quickly, that's not really a scary correction. It happened pretty quickly and the volatility index did spike. But what really would get people to doubt this rally would be something that we fall again, and maybe it's a little further than last time. That would really, you'd start to see some more intense selling, and we haven't really seen that yet. But overall, I still think that we'll end up in a correction, regardless of if we go down, I think it's going to be a correction, not a bear market. So again, during all of this, we haven't really done a lot. We sold a Chinese internet stock, took some profits there. We actually bought a social networking stock, and this is all in our aggressive strategy. We haven't really done hardly anything in our more conservative strategies. And then we also took some profits on a rail car maker that had run up tremendously. So we took some profits in some areas, but for the most part have not done a lot during all of this. And I think that's been the best course of action because, as you can see, this drop and subsequent rise, you could have easily been whipsawed. So what would happen is you obviously fall, you get stopped out maybe this day as it's falling, only to see it rally back. And then what do? You come in there and buy up here only to see it go down today. And so you need to be really careful about that. But I've looked here, basically we are at the old highs, and so it's a natural place for people to take profits. But more so than that, if you look at some of the oscillators we watch that kind of just show the exuberance and pessimism and exuberance, we went from really oversold here because it happened so quickly to now extremely overbought. The Nasdaq, I think, went up 8 days in a row, which is very unusual. I will tell you, though, and we'll switch over to the Nasdaq now. If you look at the Nasdaq here, what do we have? 1, 2, 3, 4, 5, 6, 7, 8 straight days up. And when this has happened in the past, and it's very rare that it happens when you're at a new high, when that happens, you tend to get markets that will continue higher over the next few weeks and months. So that's not to say you couldn't have a short-term pullback, but the odds are in your favor that you're going to see higher markets on the Nasdaq rather than lower when you get this type of action. But going down to the S&P for a second, so we had the Fed minutes, which they may toss out. And remember, we're looking at long-term rates and short-term rates. The Fed is going to continue with their quantitative easing reduction. That is what they said. But they've been looking at short-term rates, and they had said, hey, if unemployment gets down to 6.5%, we may start to raise short-term interest rates. Well, now they may scrap that. So some of the financial stocks didn't really know what to do with that information today and basically sold, but the market pretty much sold off as the day went on. It just got a little worse and worse. So here's the market, and you can see it opened up on the day, and then from the top down to the bottom, we actually dropped over 1%, and it was around the flat line, and then the last couple hours just sold off. But getting back to the daily, now you look at it and say, okay, we were overbought. First we were oversold. Now we're overbought. Where could we come back to? Look, this is the old breakout level. So that's one more bad day potentially. Wouldn't shock me to see us come down anywhere basically in this yellow box. I think would be perfectly acceptable. You would give back essentially half of the gains and then bounce from there and get back on track with this purple line, which is the 100-day moving average, which, again, we've shown you this several times. That's been support. It broke it this last time but regained it very quickly. So let's watch that purple line because that could be the place that we eventually kind of end up. And if it keeps moving up, you're talking the 1,800 range on the S&P. That's only not very far down there. Actually, maybe a little bit lower. But we're not talking a big drop-off here. So it wouldn't surprise me to see us pull back a little bit more because we're so overbought. But I think we're still some good news away from this going higher, not lower. I want to take a look at gold real quick. People are talking about a double bottom, and, of course, you're now hearing about a double bottom after it's already run up, right? Nobody gave you the double bottom signal down here. But if you're looking to buy gold, and it does look good from the standpoint that it broke over its 200-day moving average, and we do obviously have this double bottom. So again, just like the stock market, what you're looking for now is I think you're looking for some type of pullback maybe to this green line, which is a 20-day moving average. So that would get you down to maybe 124 on the GLD, which is a couple bucks lower, nothing major. It dropped $1 today, maybe another couple more days like today. That would be a good buy point at that spot. If you're looking to trade it, of course, you can put in some stops somewhere down here. But I think that gold still does have more upside. And really the only reason why I say that is I can make up all kinds of fundamental reasons. I think it's simply because it was oversold and beaten up. If you look at what's happening with natural gas, same thing. Look what's happened this year in natural gas. It's up about 50% this year. Now, this is the much flawed UNG, which tracks natural gas, at least it's supposed to, and it has a lot of problems with it, but it has moved up about 50% in 2014. So you're seeing that move up. You're seeing gold move up. You're seeing some of the miners move up. Obviously, you're seeing silver move up. So let this stuff come back in a little bit, but I don't think these moves are over just yet. And I don't know if people are anticipating inflation. We have a lot of inflation expectation graphs and charts we watch and monitor and data that is not saying that everybody's worried about inflation. So right now, it's just the commodities that are moving up, but the inflation expectations aren't going up. Tips and things like that aren't moving up that fast. So there's this kind of spread happening. There's divergence where commodities are starting to price in some potentially, but it could just be a trade, folks. It could just be a mean reversion trade where you had these things so beaten up last year and now they're bouncing temporarily. That's could very well be the case, and it has nothing to do with inflation expectations at all. So let's watch that. But if you're wanting to get into gold, I personally would wait a little bit and see if it pulls back, like I said, maybe to the 123 area or so. Moving on to oil, around this 102, 103 area, given what's going on in the Ukraine, I think that this could have some legs to it. Obviously, it's breaking above this area here, and we kind of have this, I was going to say a little W pattern here, and yeah, it's kind of what it is. So, you would expect that we could march our way higher to 110 given the international strife and just given the momentum it has. And if that's the case, again, what a lot of people are concerned about right now, why maybe the stock market has been struggling from 2014, is because the consumer is going to get hurt. If the economy doesn't pick up steam and yet you have all these commodities start to rise in price, obviously the consumer's getting squeezed. And that's why you've been seeing retail stocks doing what they're doing, which is basically been getting crushed. They've had a bounce here, but they've been getting crushed because everybody's starting to worry about the consumer. So let's watch that. And then lastly, let's take a look at interest rates very quickly here. Kind of in the middle. I think, again, some of these moving averages are pointing up. So they were up today based on the Fed's minutes. And I still think the path of the least resistance is probably up for this, but I don't think there's a huge edge one way or the other. I am short in my income strategy. I am short interest rates, short bonds, so I expect rates to go up, but it's a small position, and the reason I have it is a hedge against some other things that are very interest rate sensitive. So I'm getting a lot of income on those other interest rate sensitive securities and then hedging it with this security. So you're stabilizing the price movement, but you still get all the income. So that's what I'm using it for, but I don't think there's a big edge one way or the other. If we got up to 3% right up here and it started to roll over, then you may want to take the other side and actually go buy some long-term bonds. But for right now, I still think the path of least resistance may be up for interest rates. I think all it's simply doing right now is digesting this big move. Now we went up and now we're just going sideways. And remember, all this is happening, rates falling this year. If you look at really, this is where January starts. This year, rates have predominantly been down. The reason why is because economic data has stunk. And why has it stunk? Well, some people think it just stinks. Some people think it's because of the weather. It could be a little combination of both, where there's no question weather has hurt some things, but is it more than that? And there's been some signs that it may be a little more than that. So let's watch that. But if the economy, weakens, the stock market weakens, obviously interest rates are going to start going down, not up. But I think we're one or two good reports away from interest rates actually going further up. So again, I've got it on as a hedge. But as far as trading, I don't think you have a real big edge right now if you're trading interest rates. All right, folks, thanks for subscribing. A lot of new subscribers the last few weeks here. Thank you for that. Don't forget, throughout the day, you can follow us on twitter.com/Carl Eggers. You can see on the screen there all the different ways to connect to us. And, of course, you can always go to eggerscapital.com. If you got any questions, feel free to submit them. I love answering questions. So whether it's a stock or a question about interest rates or gold, whatever it might be. All right, have a good evening. Talk to you soon.